Kokkie Kooyman is with Denker Capital on a day when we have seen financial results coming out from Nedbank. Well, I think we spoke when the trading statement was out, Kokkie, and Nedbank share price reacted quite strongly there. Are you expecting that once the analysts have looked at the numbers themselves, that they will give the stock even more support?
Yeah, I think it's had a good run. I think on quite a few factors now before it continues, in line with the other banks, and obviously ABSA are reporting tomorrow, and I think Standard Bank is next week. So we're going to see quite a few results. I mean, as you say, this result was more or less in line with what we expected, except to my mind, operational expenditures, bit of a disappointment, grew at 6%. Which meant that their pre-provision operating profit, in other words, your operating result before bad debts, was actually negative. So costs grew a bit more than income. But remember, income was still under pressure. So going forward, it's going to depend more on the economy. If what we're doing and global economy starts putting us up, confidence returns and there's more spending, because that's very important for the banks. And then obviously whether interest rates go up. So stronger growth would mean higher interest rates, which is big for banks. We're seeing that in the US at the moment as well. So as interest rates go up, the banks should do very well. And so Nedbank the same. But Nedbank is cheap. It's 1.1 times price to NAV. I think it can get to a 14-15% ROE, return on capital, end of next year. So, it's not expensive. So, but it will only go further, I think, along with the economy.
All right. So what happened in KwaZulu-Natal is clearly not, and parts of Gauteng, clearly not in the numbers yet, because that happened in July and these are to the end of June. But is that not something that we should be occupying our minds? The impact. We know the ATMs were bombed out of the walls, but many of those branches that now need to be fixed. I know we did talk last time about Sasria fulfilling or meeting many of those costs, but still, if a branch is not operating, you can't be making any money from it.
Yeah. So look, if you look at I forget the bank numbers, but retail numbers showed it's 10 to 15% of capacity of branch footprint was affected. So the banks won't be much different. So you're quite right. It will on a lot of new activity. But then remember, your banks have done a lot in terms of going digital. But you're quite right. The expense is going to be staff dislocation is going to have a very tough period, and there will be bad debts, make no mistake. And they actually mentioned that Mike Brown mentioned that in the commentary. They're expecting hardship, they're expecting higher bad debts. But again, it shouldn't be that much that a stronger economy won't overcome. Or does the riots, does it have an effect on the economy? In other words, sapping of confidence, businessmen waiting for new investments, saying, we'd rather invest offshore. I think that's a much bigger impact. The costs themselves will be short-term, but you'll see it in the next 6 months. But I think if the economy returns and grows, then the market will look through that.
So what are the banks telling us at this point about where those confidence numbers might be heading?
That's a good question. We'll see when, as I say, ABSA and Standard Bank have come through as well. We see that. Sorry, that is. Always happens. Okay, start that one again. We see globally that consumer spending and consumer lending is coming, but corporates are not really lending yet. And I think the same here in South Africa. So your consumer is spending, and even in Nedbank's number, you see that there are new initiatives in the lower, where they've never really had a presence, where they've started trying to push that. That is actually picking up nicely. So the consumer growth is coming through. But I think in terms of real investment, that will drive economic growth. Banks are not really seeing that yet. You can see that in the loan growth numbers, which is still lackluster, to put it that way. So you need corporate demand to come through. And look, some of that will actually, funny enough, because of the riots, will happen because there will be new restocking. So there will be all the stuff that was looted and burned for that. So that should help a bit for corporate lending, but you want it to be sustainable. So we still in that regard, your question, if you look at the results so far, we're not in a good space of the bank lending, and the bank outlooks reflect strong confidence.
Kokkie, where does Nedbank come in the whole setup in South Africa? We know that FirstRand's the biggest, then there's Standard Bank, then between Nedbank and Absa. Who's winning this banking war? If you go back over maybe the last 10 years, we know that Capitec has certainly been the star performer, but of the other banking members, how are they stacking up there?
So if you look at the last 10 years, then the losers have been sort of absent Standard Bank, mainly lost clientele to Capitec. FirstRand initially lost as well, and are actually winning the space almost on most fronts. That FirstRand are the leader. Nedbank have always been the smaller bank, focusing more on commercial, corporate, especially property-based lending, and that's obviously been hit badly by COVID. So the price fell as much because of their big exposure to commercial real estate, which, by the way, was really conservatively done, so very low, what we call loan-to-value ratios. But so Nedbank is the smaller of the four, and I think what they've done post-Old Mutual, which, by the way, I still think, it's my thesis, I think that would be quite an event. It was quite an event for them, putting the team together, saying on their own, now let's do it. And you can see there's some initiatives, there's more focus on technology, on making sure the bank ranks high in terms of client service, and your apps doing business directly, and also on the lower end of the market, retail lending, which is higher NIM. So they're trying to rebalance a bit away from corporate to net interest. Bottom line is your question. It's the smallest of the four banks. I think the clients that use them like them, but it's very tough for them to actually grow now, because you've got to fight for market share. And so they're trying to do that with client service, but they're the smallest of the four. It's the hardest battle for them to pull clients away from the big guys, the other three.
I suppose because we're seeing so many new entrants into this space. Discovery Bank has been very aggressive. They're probably spending more on advertising than the others put together. It's certainly so it seems. And then just recently this week, Bank Zero opened its doors. Well, not really, because it is a virtual bank. But how are they doing? How are the challengers, as they call them in the UK, these challenger banks, doing, taking on the big four? And particularly, is Nedbank, being the smallest of the big four, more vulnerable than the others?
Yeah, look, so your so-called fintech or challenger banks globally all start more or less, actually, funny enough, with Capitec started on the retail lending. You recall Capitec in 2001 to 3, a bank lending to higher risk clients where it made very good margins, and it provided the service to those clients that other banks weren't. Slightly different, where your fintech banks all over the world are using newer, cheaper, and better technology to attack banks and on the weakest spots. I mean, some of them has just been credit card fees or Revolut on the money settlement market, and where bank margins have been too high, service been bad, so that's where they're going. Zero, Michael Jordan and the guys originally tackled this as a transaction bank for so-called SME corporates, smaller and medium enterprises. So smaller businesses who normally have to pay more for bank charges because they haven't got negotiating power. And so they've said, okay, we're going to have Bank Zero. We're going to offer you bank services at a very low rate. And because their technology is new and better, they can compete with the other banks. But initially, that's very small. We see that globally, very few of them are profitable. And although the numbers are growing, Brazil, we're seeing the tech bubble of the world, Brazil at the moment, you're seeing like 80% more client growth, but most of them still not profitable. So you've got to branch out into, so what you're hoping is you get a client base, you're growing a client base, and then you're selling other bank products to that client base and so grow. So discovery as well, it cost discovery, I think, must be 4 times more than they originally projected to get the bank going. And then you've got your big advertising spend, as you say. So it's not cheap, but yes, it's about momentum. If they can continue growing the client numbers, then they'll become a challenge. But each time it's just in very small areas, and then they grow into. So Nedbank, because commercial lending and corporate lending, that's normally the last area where your fintechs or your challenger banks go. They have more attack on the retail side or on the smaller business side.
It's so interesting. I know from my own perspective, I opened an account with Discovery, and it wasn't hours later that Investec were all over me like a rash, telling me how they could improve their offering or how I hadn't been using the offering that I could. And having a look at what they are offering, it's very, very hard to move anywhere else. And I guess just that's a survey of one, but I'm sure that many people are faced with the same challenge as an SME. Now, do we even look at Bank Zero when we've got Investec who can actually do business banking for you as well? And of course, you've got great transactional banking from FNB and then cheap banking from Capitec. So you end up with all these bank accounts, and one day you want to consolidate them all. It doesn't seem likely that we are going, though, that would be consolidated in one of the challenger banks, because I suppose they haven't been here around long enough. So how do they get their business? And it's a very serious question, which might seem a little flippant, but many of us who are in business and have got bank accounts are only trying these new guys with a second or even a third bank account. And at some point in time, you got to say, hang on, life is complicated enough. Why not simplify it and just bring it all back to Investec?
Yeah. So number one, the consumer is the real beneficiary of banking. So your bank clients are certainly getting better banking at lower costs. So there's no way about that. It's very good for the consumer. It's very good for inflation as well, in terms of at least that small part of inflation. The bank costs are contained. And so you're forcing your large banks, we see that globally as well, large banks are just forced to think much harder about profitable activities, about their margins, about becoming more responsive. So how the model generally works, and I saw it like you, I was also offered Discovery credit card, I take it, and then so suddenly you've got another card in your wallet, and that's really what they try and do, is get you to have 3 or 4 banks, and then the one with each time the best offering. My wife loves the Nedbank green points, or she's always on about the greenbacks. So, and so you start steering your clients. So I've been using my Discovery credit card a lot more simply because it's so quick and easy. And so that's what Bank Zero does as well. And all these smaller guys, they try to muscle in on one product and try to switch you to move from your larger bank for that product. But you're quite large banks like Investec, brilliant example, have best in class on a number of products. So if you with Bank Zero, well, they don't do lending yet, but Time Bank, Discovery, you can't get a mortgage and you can't get a vehicle loan. So then you've got to go back to Investec. So and that's really the play. So the advantage for the larger banks is they've got time to really improve and make sure that on all fronts they beat the smaller. The battle is really there, and the smaller guys will keep trying to muscle in. And then what you will find is the guys who can't quite make it will start buying out your M&A, will start buying out the fintechs that don't make it, just for the client base, not really for the technology, but if they think they can't get that client base themselves. And often it's simply because the focus is different. Discovery Bank will focus on a different client base than Bank Zero, then Time. So at some stage, maybe, well, that won't happen because of the parents, but those three together might be more powerful because you've got a more diversified client base. So I think that is how the thing plays out. So each one first try to do as well as it can in this area, but they'll have to branch out to maintain those clients. The cross-sell ratio, what a lot of guys call the ecosystem. Banks want you in their ecosystem where everything you do, from movie tickets to meal to whatever, you can do through the bank. And the smaller guys, the fintechs, can't do that yet.
It is so interesting. But when you as a consumer are being bombarded with different options, should you take them? Should you maybe open an account with this one and the next one? Because actually it would sound like they might be loss leading options just to break into the market.
Yeah, no, you're quite right. So consumers benefit initially from trying out the newer banks because you certainly get a better deal because they're all trying to break in. So they're trying to give you a good. So as a consumer, you can't lose, except your risk is obviously that if you use each one as a lending bank, that you start, like, I don't have control of my wife anymore because she's now got 5 credit cards and she used to have 1. I mean, as an example. So that's your danger.
Did you ever have control over your wife, Kokkie?
No.
That would be a first. Yeah.
But your points are very valid. That I think for the consumer, it's become very simple. You'll recall in the old days that the last thing you did was move your bank account because it was just too much of an admin schlep. These days, the bank who you move to will do it for you, and all online within an hour. So you can afford to open an account and close it and experiment. If you're that way inclined, it does create more work for you. It's simpler to have it all in one bank. But yeah.
But I guess that's capitalism. And a wonderful saying from Silicon Valley is that the startups need to get distribution before the incumbents get innovation. And the incumbents in South Africa, being as powerful as they are, with the distribution as well, if they continue to innovate like a First Rand, which prides itself on that, it'd be very hard to knock them off their perch.
Yeah. No, absolutely. I think the main advantage the large banks have in South Africa is that South Africa is a fairly small country. It's very and I used to say to Michael Jordan as well, Michael, why are you starting Bank Zero in South Africa? If you were to start this in India or in Pakistan or in a country with large, maybe not Pakistan, but Bangladesh or country with large client base, once you take off, I mean, you really do well. South Africa is just small and low growth, and you can already see in Time Bank now doing link up in Philippines, where they're linking with. So in future, when ARC and Time Bank and the shareholders have to decide on allocating capital in Time Bank, do you allocate more capital South Africa, or do you rather spend it in Philippines and maybe another country? And so, whereas the large banks are here, but the smaller banks, technology makes you internationally transferable. You can use the same technology to a certain point. Regulations are different, but you can use it in other countries. So I think that will be a protection for the large banks. The real innovation in South Africa will rather go and allocate their capital offshore.
That is so interesting. So on the one hand, it's almost like a pressure cooker because of the highly competitive South African banking market. But if you take the lessons learned here, you could apply them elsewhere in the world to great effect. And you wonder why Capitec, for instance, which has done so well here, hasn't done exactly that elsewhere in the world.
Yeah, I used to ask Rian and Harry that question quite often. The answer was always that they've still got so much growth opportunity in South Africa, and they were right. I mean, the growth. Even now, they're still only 2% of bank assets in South Africa, so they're still small. So they said, okay, we'd rather make sure what we've got here will do well. They were quite confident in their own ability to keep taking market share. And then the second one is Paul Harris of FirstRand many, many years ago in the 80s. You recall FirstRand tried to go to first Australia and then later also Brazil and India. And Paul Harris always said, when the Australian venture didn't work, he said, if you want to compete in another country, you can't send your second team. A lot of guys make the mistake, they send junior managers or guys, and you're going to compete there against their first team. So you're going to go and compete against Australian banks' first team with team. You've got to send your top guys across, and then you take away from your own business. So that's always the challenge. But that's why I think Time Bank was clever going with Philippine retailer, the equivalent of Pick and Pay there. So, but then you must make sure that your software that you've got is so good that someone from Philippines says, hey, we can use this. And I think that's where the move is. By the way, Capitec, as you know, did invest. They've got a 25% stake, and I think that's actually been increased. 25% stake in a business in Eastern Europe called, unfortunately, Cream Finance. Not such a good name, but Cream Finance in any case. Investor, but has investments, I think, now in 7 banks, mostly in Eastern Europe, 1 in Mexico. So what Capitec got with that, they get a ringside seat at the table. All the regulatory issues in all these countries, how do we grow? And they can sit and listen to the problems these guys are experiencing and bring their solutions as well. So I think that was brilliant of Capitec when they did that route. I think it was 6-7 years ago when they made the initial investment. And little is actually said about it. People ignore it. But once Capitec goes X-growth, I think they can really continue with that.
Kokkie, putting it all together, where would we be putting our money or our investments into which banking stocks today?
Yeah, you're of the 4 or 6 actually, I suppose. ABSA and Nedbank still are very cheap. ABSA, because if they've overcome last year, that management team is really doing well, and we'll see the results tomorrow. I was worried that early burst in lending they did might result in bad debts. Well, we'll know tomorrow, but I think I would say ABSA, the Nedbank, and Investec looks like it's turning around as well, doing very well. Remember, they always battled in the UK as well. The UK economy will grow well. So those 3 are certainly, in terms of value, are very attractive still on the longer term. And in terms of what they can do, so I would go for ABSA first, and then a toss-up between Nedbank and Investec on the shorter term. Longer term, 10 years, FirstRand is just the best. You stick with FirstRand, and then